Let me ask some kind of rapid fire questions. Say I'm going to buy some real estate. Should I buy my practice and the building my practice is there special benefit because I am a physician, I work in there? Can I use some the tax benefits? Is it a special exclusion or is it just treated like any other real estate?
It's treated like any other real estate.
Got it. Okay, easy enough. So, depreciation. Say I'm trying to maximize depreciation because I have a lot of depreciation recapture. Should I buy my own properties strictly from a depreciation sense or do passive investments?
Um, it's you're gonna get the same outcome, kind of either if it appreciate as long as what you're buying is something that is going to be a passive real estate investment, whether you own it through an LLC or a syndicate, or you own it directly, it's gonna still have the same tax treatment, regardless.
But you
Was
will
that what you were
work much
asking?
more.
But
You will
from
work much more to get the real estate that you buy
yes.
directly, by the way.
Yeah, but strictly from a depreciation standpoint, dollar for dollar, you get a lot more depreciation because of leverage on your active real estate. Like if I say I put down 50,000 for a $200,000 property, right, down payment of 25%, I should get a lot more depreciation assuming you get, 50% of the value. So maybe I get assuming I do cost seg and bonus depreciation, all that stuff. I should get $100,000 of depreciation as opposed to maybe a $50,000 investment into a passive deal where I'll get about
So
25,000.
So it's more nuanced than that. It really depends on the cost segregation study. But generally speaking, like when you're investing in something that is more like a duplex, like a, not a
Mhm.
compound or like a commercial property, like then how the depreciation is being calculated, it's going into the details. How exactly is the cost segregation study is being made? Like who is doing that? What is the property? And of course, for certain properties, you can squeeze more from the study than from other properties. So a lot of the time, one of the reasons why people like to invest in funds is that they have access to certain properties that you can squeeze more depreciation. Not because like there is a difference between one depreciation or the other. There is a difference between the properties, the types of properties, and how they're being structured and how depreciation is being calculated. And the cost segregation study is being done. So that's something definitely to just take into account. If your goal is really the you want the depreciation, that's what you're aiming for. It will be much easier for you to go to the fund who has probably experience doing it many times, so they know more or less and they can estimate for you how much you're going to get. While if you're going and do it yourself, you don't really know where you're going to end up with the depreciation. You're going to somebody who knows what kind of cost segregation study they will do and how much depreciation they will give you. So you have a bit like it's more like ends up. It's a bit more professional. It's a bit more just passive, honestly, and worry free. Like if you're going with like any like a syndicate or fund that has experience doing that. So that's something definitely it's not so much from a tax perspective, it's more like from a business perspective. It's the way that you want to think about it overall. And I'm saying it as a passive investor in real estate myself, by the way. Pranay, we need to talk maybe. My
Yeah.
wife is a physician, so maybe we can also
Uh,
become
uh,
investors.
yeah. Last question. So, filing state taxes is always something that is bane of everyone's existence. So, what are your thoughts on? So, say you have, I know you have a lot of physician clients. What are your thoughts on filing annual state taxes in states where you have large losses?
In general, it's usually a decision that will kind of approach. It depends on what you expect to happen with that investment. If you're just reporting losses, you technically should be able to carry forward those losses. You might not have a filing requirement in that state. It does depend state by state. Some states will say if you have any type of income or loss, you always need to file. Some states don't necessarily require a filing. The most conservative way to file is, if you always file a return in that state, there's no question on, you're always capturing that loss, carrying it forward. And in the event that you have a positive exit, then you'll be sure to reap the benefits. People can get that same sometimes, again, depending on the state, you can get that same benefit with maybe without needing to file a tax return every year. And that's a decision that usually people weigh the cost of filing a tax return, what they expect the outcome to be, and can make a decision there. Sometimes there are also options to file consolidated returns. If you have an investment that has multiple like non-resident investors, participating in a consolidated return would be an option. In general, sometimes you don't have to file your own personal tax return in that state, so you definitely save money there. Everything will get reported. The downside can sometimes be if there is maybe a profit in that
Mhm.
state, and the percentage of the profit is extremely small compared to all of your income.
Mhm.
You might pay less tax by filing the return yourself, because you depend, again, everything depends on the state. So you might be able to end up paying less, where if you file a consolidated return, they're probably going to charge you a flat rate based on your filing status, not take in any other considerations. So it's really a case by case basis.
Okay, two questions from people that are live. The one or two sentence answers. So, premiums for personal disability insurance, can it be deducted as a business expense pre-tax, or does it come out of paycheck post-tax?
It can be premiums for it can be either way. If you're paying it out of pocket,
Hmm.
then it would be an itemized deduction, which you may or may not be eligible to take. That would be on Schedule A. And then if your employer does offer it as a pre-tax deduction, then it's pre-tax.
If you're your own employer, can you say it's pre-tax?
It depends on your plan. You can't give yourself a different treatment than, like, you have to have a plan depending on if there are other employees.
Hmm.
You do have to kind of structure the plan. Um, that'll determine, and if it's an S corp with a 2% shareholder, then there are also additional rules. But it definitely can be deductible.
And if someone has real estate overseas that they're selling, is there a way to bring that money back while offsetting taxes?
If you have real estate overseas, you're subject to different. If you're a US resident, you're still going to have worldwide, you're going to be taxed on your worldwide income.
Hmm.
Um, so depending on if you pay tax in the other country, you would still be taxed in the US on that income, but you could, if you pay tax in the other country as well, you get a credit. I mean, the income is yours, you're paying tax on it. So whether moving it from one country to another, that's not necessarily the tax event. But if you are paying tax in another state, you would also be paying tax in the US, and you get a tax credit. So you ultimately end up paying whichever tax is higher.
So it kind of depends on what the tax situation is in the other company, if they have depreciation and all this other stuff that we have. The US is very forward thinking when it comes to real estate. It was
And
also
taxes in
created,
general.
huh?
And taxes in general. The US, I think it's by far the most advanced tax system in the world. As much as we like, people complain about taxes no matter where they live. But if you compare the US taxes to the UK, to Europe and other places, we're paying so much less.
Yeah.
That's the truth.
Yeah,
Um,
and I mean that's a reason that, a lot of Silicon Valley, a lot of if you look at like how many companies are worth, billions and billions, and how many startups, there's not that
yeah,
many in Europe. Yeah,
yeah,
yeah.
yeah.
Great, awesome. Thanks, you guys.